Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today is Mark Burgess, Chief Investment Officer EMEA and Global Head of Equities. And we're going to talk through some of the key themes driving markets. These include the ongoing fallout from the UK referendum on EU membership, the actions of central banks and potential political headwinds. So Mark, we're a few months on from Brexit now. Have things turned out as expected, and how are we viewing markets?
Things have turned out as expected in one way, in which is that we thought that sterling would come under quite a lot of pressure as global investors fled the currency, and we have certainly seen that. We've seen a significant devaluation, probably by more than we had expected. The converse to that is that markets, both equities and fixed income markets, have probably performed better than we had thought, and that's as a result of ongoing quantitative easing and central bank intervention, both by the Bank of England and also by the European Central Bank.
So what are the key risks, given that markets have performed so well?
Well, markets are at relatively elevated levels. Both credit and equity markets have done well, as we've said, and I think the key risks are just of an ongoing economic slowdown. Despite best efforts by the central banks, growth remains relatively subdued globally. There are clearly ongoing geopolitical risks, both in terms of Eurozone politics, US politics, but also Middle Eastern politics. And, profits are under some pressure as a result of the slowdown. So I think there are quite a lot of risks out there, and valuations are relatively elevated, particularly in core fixed income markets.
Given weak global growth, do we expect central banks to continue to provide supportive monetary policy?
I think central bank intervention is absolutely here to stay, and there's a commitment from central banks around the world to continue to provide stimulus to the economy. I think the thing we need to think about as the next stage, as global growth remains subdued, is whether the politicians start to introduce some level of fiscal element to their policies and actually start spending some money in an attempt to get growth going. So I think that's potentially the next penny to drop, but we need to wait to see that come through.
The odds of a Trump victory in the US presidential elections have shortened. What are the economic and market implications?
He's certainly advocating a very significant fiscal boost to the economy. I think that will put some pressure under both the dollar and also treasuries, because core bond yields in the US are pretty low, and with regards to the tax cuts and the spending measures that he's looking to introduce, that would be a very significant loosening of the fiscal rein. So I think that would have quite an impact. I think it will be a relatively big risk-off event as well, similar to what we saw in Brexit, but whether markets would rally like they have after Brexit, would have to wait to see that come through.
And staying with the political theme, we do now have a date for the Italian constitutional referendum, and then we have German, Dutch and French elections next year. So what might all of this mean for the Eurozone?
I think it's going to mean a continued spotlight on the Eurozone, an ongoing focus on where the weak points are. So there's an element of political uprising with regards to populist politics, and certainly in the aftermath of Brexit, many European countries are seeing similar calls for leaving the EU. It would be a much bigger deal for the Eurozone were one of those countries to think about leaving than it is for the UK, and it's a pretty big deal for the UK to leave. I think that's going to place the spotlight on the Eurozone. I think it's going to place a spotlight on the financial system, and I think it's going to keep risks to the fore for investors to think about. So there's a lot to digest over the coming 12 months.
Mark, thanks very much.